Stock Play of the Day is an educational program. Any statements made by Ally Invest employees are not intended to be or should be considered investment advice, a recommendation to buy, sell, or hold a security, or a recommendation to adopt an investment strategy.
Hello and welcome to the Stock Play of the Day Overtime. On Tuesday's Stock Play of the Day, we talked about Cleveland Cliffs. Today we'll discuss, did we score or did we fumble? Hello, my name is Brian Overby. I'm the Senior Options Analyst with Ally Invest. On Tuesday's Stock Play of the Day, we looked at Cleveland Cliffs. Specifically, we talked about a long call in Cleveland Cliffs going into earnings. We are running into the earnings season right now. A lot of the financials announced earnings last week. Cleveland Cliffs is expected to announce earnings on the 22nd of October. So we're looking at the long call, and we specifically picked a long out of the money call as a fear of missing out around earnings. We went out further in time, a little bit out of the money. We managed our risk by buying a little bit out of the money. And so far, let's see what's happened this week in Cleveland Cliffs. So if I run to our Ally Invest chart here, this is our live chart inside the live trading platform. We always tape the Stock Play of the Day live at noon on Tuesday. So noon on Tuesday is right here. I'm showing you a 15-minute chart. So throughout the rest of the day, the stock went down a little bit, and it opened down on Wednesday, made a strong bounce back on Thursday. But if we look at the actual fluctuations in the price of the underlying stock, the high here is 22.20. The low is 20. I guess we could go all the way down here, 21,828. So we don't really have a wide range. When we look to place the paper trade on Tuesday, the stock was at 21.93, which is represented by that ray on here. So what has happened? Well, the market's down a little bit. We're at 21.61. So we're down about 30 cents or so on the underlying stock. So not that big of a deal. We wanted to get into this position going into earnings. We bought an out of the money call to manage our risk overall. So let's go and look and see what is going on with the trade. So inside the Ally Invest option chains, on the left-hand side, we have the calls. On the right-hand side, we have the puts. Underlying stock is, well, right now it's up 5 cents. It's even though down since Tuesday, but it's up 5 cents right now. Highlighting the earnings date on the 22nd, and that's the important date that we wanted to have a position on before that earnings happened. January 21st was the expiration. So we were 101 days out. Now we're 98 days out. So still a lot of time. And when I'm buying out of the money option contracts, especially around earnings, I'd rather err by buying more time than not enough time. And this is more of a longer term play going into the end of the year, kind of hoping that the markets bounce back after what they have done all through September. Had a little bit of a rough month. It wasn't that bad. It was more volatile than anything. Now we're in October. We're getting to the end of October. Hopefully we're looking to kind of rally a little bit into the end of the year in this sector. So with that said, this is the option contract we looked at. We looked at buying the 24 strike January 21st expiration. Now, when we put on the trade, when we're looking at the trade, the stock was at 197. Right now we see this, or I'm sorry, the option was at 197. Right now we see it at 149. So cause for concern, we've lost a little bit. We probably had a little bit of a fluctuation in implied volatility because that position is down a little bit more than I would have anticipated. Now we have earnings. I would expect volatility to pick up a little bit. And basically this option contract should have some implied volatility because we are going to be running into earnings here on the 22nd, which would be, I think that's going to be a Tuesday, right? So right now, today, the date is the 15th. So overall, what could we do? We talked about this on Tuesday's show. What would be an alternative to sell against our position? And we emphasized in the show that we did not want to do this going into earnings. The whole reason why we are buying this option contract is we want to have the upside if we have a solid earnings report, and we are managing our risk to the downside and limiting it to the premium that we paid for that option contract. Now, after earnings, if you wanted to sell something against it, I would look at maybe the November 5 expiration. Now, you'd have to see where the underlying is at. But obviously, if you go out and you look at the different strike prices that are available, if the market's up, maybe you look at a 27 strike or a 25 strike, and that trade would actually then be called a diagonal. So inside the options playbook, I'm highlighting a diagonal spread. That means we have a longer term option contract and we're selling a shorter term option contract against it. I would consider that an advanced trade. I think the hardest trades to get your hands around are trades where you have different expirations. If you did this trade, you went out and ended up after earnings selling a call against this position to try to bring in a little bit of income on that trade, you need to make sure that you have an alert set your reminder on your phone or whatever that on November 5th, you're going to have to do something with this option contract. If it's out of the money, no worries. It could expire worthless. If it's in the money, you might want to roll it or close it. But bottom line is with a diagonal, you don't own the stock. You own an option that gives you the right to buy the stock. So you may have to do something with that position overall. So what's the theme today? Do nothing. We're down a little bit on the stock. We still have the earnings report. We got our position on fear of missing out going into earnings. It's going to be that case for a while. All earnings season has just kicked off. This is one way that you can take a position, manage your risk, still get some upside. Now, also highlighted that if you're doing this position, we're not using the leverage factor in the options. This is actually an alternative to buying 100 shares of stock. We're going to buy one call option because we were thinking about buying 100 shares. If we're going to buy 200 shares, we'd buy 2 call options. And that way we're truly limiting our risk to the premium that we paid for that option contract. All right, that's it for this edition of the Stock Play of the Day Overtime. Please click subscribe, ring the bell, and we'll see you this Tuesday for the next Stock Play of the Day.